Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, we've got Jun Bei Liu looking at what the market might do before August 10 or maybe after August 10. August 10 is the day we get the US CPI number. It was 9.1% in June. We're hoping for a better one in July. If it's a good one, great stuff. If it's a bad one, well, we might see this rally turn tail and run to lower levels. Let's hope that's not the case. Then we've got Mike Gable. Mike's from Fairmont Equities. He's our charts guy. He's looking at a number of very interesting stocks, particularly tech stocks that have done really well, the likes of Zip and Tyro. EML, which hasn't been doing well, has been copying it. Just about every announcement it's put forward has been negative and terrible. And he looks at companies like BHP as well, and a gold miner that he thinks has a lot of potential. And then poor Rickard looks at Horizon. Horizon, I often describe as a boring company. It's involved in toting coal around Queensland and other parts of Australia, but it's a very good dividend payer. Paul's view on where this company is going is a really interesting one. That's the program ahead. Before I introduce Jun Bei Liu to you, let me remind you, August 10 is a critically important date, and the market really is hoping that a good inflation number comes out on Wednesday US time. Our market will show it on Thursday. As I say, good inflation number should be great for stocks. Now let's have a chat with Jun Bei Liu from Tribeca Alpha Plus. Thanks for joining us, Jun Bei Liu.
Well, thank you for having me, Peter.
A good day for the market, not exceptionally, but given the fact that the Americans got an extraordinarily good jobs number on Friday, which could make people think that interest rates will keep on rising in the US. It's not bad that we've continued to rise.
Absolutely. Look, the market did look a little bit shaky to start with, but clearly it's buoyed by some of the M&A news that is in the market. So we see the miners doing quite well today, given the
BHP is chasing Oz Minerals.
Oz Mineral, that's right. And clearly Oz Mineral said no. The board said no. They said that out of the last 12 months, 5 of it, they were way above that price. So they want a bigger price, and now it obviously sent the boost to the rest of the copper stocks. Your Metal 29 and your Samphire and things, they all rally very strongly. Another thing is all the lithium names are rallying very strongly. It's partly because they are now seeing BHP's commitment to the green metals and green metal, green energy as essentially.
Green metals we're calling them now.
Yeah, green metal.
You're always on the cutting edge, aren't you?
That's right. You got to get to the forefront of the wordings. So lithium is going to become a very integral part of it. So you're seeing the lithium names rallying very, very aggressively today as well.
Okay, right. So that's the mining part. And some of the less quality in tech stocks have had a good day too.
Oh, absolutely. It's actually quite selective. Like you said, the US better job market has sent some of the larger tech names down a little bit today. Not meaningfully, just down a little bit. But some of the really smaller end, the speculative, more not profitable tech is having a huge day. And the ones that recently downgraded is having a huge day. The likes of Appen is up 10%. You've got PointsBet, not tech, but growth. It is up high single digits. We've got Redbubble is up something like 15%. So there's quite a lot of bounce in those stocks, which does suggest it's kind of like short covering by long-short managers.
Okay. We've been saying here for a long time now that every time these tech stocks do well on potentially less interest rate rises, it's like a sneak preview for the end of the December quarter, when both you and I think interest rate rises probably are over, and the market will say, okay, we've gone over the top in selling these stocks off. Now let's try and pick the ones that really are good value. Is this another one of those sorts of days for those sorts of stocks?
Yeah, absolutely. It certainly feels that way. And how rapid these stocks are recovering now, it certainly seems like by December quarter, they already recovered quite a big part of their loss. Absolutely. The bond yield is stabilizing. Even though job number was good, we didn't see the bond get sold off enormously. It's a little bit of weakness. So just suggesting markets, pricing those high interest rate already.
Okay. So the story I wrote on the Switzer report today focuses on an important date, namely August 10, when the US CPI number comes out. Now, let's just go through some scenarios. Imagine the number is, well, last number was 9.1. Imagine that number still is around 9. What does the stock market do?
Look, the stock market will be sold off on the back of that. It will make people worry about maybe the recession will be far more severe than what is expected now, because now most people believe inflation's peaked, so it will come off below 9. And then in that environment, stock market is pretty good because you know, corporates have pricing power. You put through price increases, and yet the demand is still there. So in that environment, it's pretty good. But if it's going to be very severe inflation and interest rate going to escalate really rapidly, we might hit very severe recession.
So a lot of this rally we've seen has been on the basis that the market over or exaggerated how far rates would go up. Lately, they've pulled them back, and the stock market's like that. So if we get a good inflation number Wednesday US time, and therefore we'll see it on Thursday. So imagine it was 9.1. I've seen numbers like 8.8, but imagine it was like an 8 or a 7.9. I think the market would really like that.
Oh, market would love it because that just goes to show the commentary so far is right, because you know, it's peaked, and that means interest rates doesn't have to go as high, and we'll go back to the normal trading environment.
And at a time when the US economy is doing well, even though it's doing really in a technical recession, those 580,000 jobs, 285,000 jobs. I think it was 258 they were expecting, and
exactly,
it was 285.
Exactly, it was incredible.
It was extraordinary. So if they've got growth with falling inflation, it sounds like a Goldilocks scenario.
Oh, absolutely. And this will be the same for around the world. We will feel very similar sort of environment. So it's fantastic for equity markets.
The only thing I'm a bit annoyed about is all the good news I was expecting is coming a little bit too early.
It's too quick. That's right. We're waiting for December quarter. But you know what? As long-term investor like you and me, we'll probably be buying all the way down. Quality companies, you don't have to worry about their earnings. They will come through. And the current share price volatility is just temporary.
The thing is that, do we buy before August 10 with courage, or do we wait to see August 10? I think most people will wait now.
Yeah, I think it's too close.
We're
almost there.
Yeah, exactly right. All right, so what stocks have you liked over the week? Has anything come on your radar screen and you said, hey, I didn't think about that, I like this one now?
Oh, look, I think most of them we have positioned into the result pretty well. Things like, you know, the REA is going to repeat a report tomorrow. Listing so far has looked pretty good. You know, we like the things, what else do we like? We like the likes of ResMed that's reporting this week. Things looking pretty good. All of
CSL sneaking up to nearly 300.
Nearly, So you are seeing the CSL hitting that 300 mark, and everyone's like, oh, it's time to sort of take profit. Look, you can be tactical in things, but this is sort of one of those bottom draw sort of stock. It has had a big rally. Maybe you can take profit into some smaller names, just for the market bounce, but it is incredibly defensive, and you know, it's good to have in the bottom draw.
I noticed in America, and I'm sure you picked up on the weekend, that one of the online retail businesses did really well. And people keep asking me about Kogan. And I have problems with Kogan. I know Russell, and I interviewed him, and no one knew him. And he had a great run during the coronavirus pandemic period. But I think a lot of people have question marks over the longevity of the business and whatever. But he is a classic online retailer. What's your view on online retail generally, and then Kogan specifically?
Of course. So look, I think the online retailer is just going through a period of consolidation. They've just done so well in the last few years, you know, hundreds of % of rise. It's bound to come off. So that is the challenging part. I think net, they will reduce costs. They have shown recently, you know, the cost, they'll cut the costs and try to improve the margin. But it is just a very challenging environment. Looking at the likes of Redbubble, they have made a lot of money from selling masks, and now that revenue is not going to be there for the next little while. And so you know, so they are going through a very challenging phase. Next 12 months, the competition will pick up as well. So because previously you can't get your hands on stock, now you got a lot of stock, you need to clear it, and a lot of people are probably not buying stuff. So all of that together, just the environment is a little bit too challenging. I think Kogan's Russell is a fantastic entrepreneur, and Kogan needs him to be able to be very agile, to work out which line is quick, and he's very quick to get on the trend, see what's selling, and move them and things. I think it's great business. Just next 12 months is going to be a little bit harder. But if anything, I think in this environment, I'd like to pick up some of those stocks.
at low prices.
At low prices.
You'd gamble on.
Yeah. Look, I think you've got to take a little bit longer term view. 12 months, in the next 12 months, you will see more share price.
And I guess he's always a takeover target, isn't he?
Only if he will sell. I think that's challenging.
That's right. And yeah, but it's an interesting business model. So one last area, a company like Webjet, I really liked it when the market sold off. I thought it was ridiculously low, and I was prepared to wait 2 or 3 years.
Exactly.
And it did well faster than I expected.
Yeah.
But now we know you can't get a flight on a ticket, on a plane. And if you do, you pay extraordinary amounts. Is Webjet ready for the next leg up?
I think the challenge will be there for 6 months at least, because what we're hearing everywhere is actually quite negative in terms of volume. Because there's so much indigestion in terms of people traveling and things. A lot of people are actually cancelling those trips and things and push it out.
Yeah.
So if anything, I actually think in the short term, the earning expectations is a little bit high, just because, especially across Europe and things, all the volume is just people couldn't get things through, and then everything's costing far more expensive. So the actual overall spend is now shrinking. Yeah. So that's the challenging part for the travel agents.
And I guess also there's the issue that a lot of businesses are using Zoom and Microsoft Teams. And once upon a time, they travelled. Now, part of their business is the business bed market in hotels and things like that as well. So it's going to be interesting to see how they're going to go. But I'm just wondering whether it's another 1 year wait, but it's potentially a good buying opportunity.
Yeah, look, I think in the next year you probably will get buying opportunity. It is definitely a 1 year wait. It's so far been trading on the hype like every other travel agent, and it's a great business, and I love the exposure. But now we're sort of already passing the European holidays. Now we're heading into the winter season. Things generally trade a little bit weaker on the basis of that. So look, it's a wait and see for this one.
The only thing, one of the reasons why I asked you is that there was a story out over the weekend that I think it was like 428,000 Australians went out of the country, but only 258,000 came in May. So we're exiting the places. We are intrepid travellers, but the rest of the world still finds out the trip to Australia a long, long trip.
Absolutely.
And before we wind up, is there anything else you'd like to make comment on about the market so far?
Look, I think in terms of market so far is that, buying opportunity is actually, you're constantly finding them. And this reporting season, you will actually see quite a lot of price movement. So it's very important you find the companies that will potentially beat expectations, and they can move a lot, as we have seen, with the likes of Kogan and others. Share price can go up quite a bit just because there's no conviction in the market at the moment. So I do think there's quite a bit of return can be generated out of the reporting season.
Okay, and listen to you, I had one little memory of a stock that probably has caused you a nightmare, A2 Milk. It's had a good run.
Had a great run.
And I'm sure you would have investigated the FDA thing as well. What's your hope for A2 Milk over the year ahead?
Look, I've become more positive more recently.
I've hung in there.
Yeah. Look, I've got a long short, then anyway. So we got more positive more recently. Just share prices had come off so much, and there was so much negativity when China 2 months ago went into lockdown. Shanghai went into lockdown again. So share price was sold off and things. So much negativity. Then more recently, I spoke to quite a round of analysts in terms of expectations. If anything, everyone's rebased their expectation to really, really low. So I think they're actually going to come out with okay results. Knowing everyone's already downgraded their earnings. And secondly, I think the FDA, they are close. You don't get a notice like that if you're much further down the track.
Yeah, and I feel as though the Democrats want a bit more competition in the market, because it was ridiculous. It was basically two suppliers, with one in particular dominating the market. So it's going to be very interesting to see how it goes.
If they get that, the share price will absolutely rally on the back of that.
I know my sister in America, I gave her the tip on A2 Milk some time ago. We need it to rebound to reinforce my credibility with my sister.
It's absolutely coming. Not only FDA, and the result will be okay as well.
Okay, great stuff. Thanks for joining us. That's Jun Bei Liu from Tribeca Alpha Plus. Well, joining me now is Mike Gable of Female Equities, and because the market is turning, I want to see, and a lot of the companies that we've been talking about are starting to have some upside. I want to see whether the charts are saying they've got legs, that this upturn is more than just something temporary. Mike, thanks for joining us.
Thanks, Peter.
Yeah, you might know some of the names I've asked you to look at. They are names that have often featured in this particular program, but I'll be interested to see how they go. Let's kick off with the overall market. The S&P 500 is critically important to our market. Whenever they're positive, we go positive. Tech stocks do well over there, tech stocks do well here. So what's the S&P 500 telling you right now?
So yeah, everything is looking a lot better at the moment. I mean, during our last conversation about a month ago, we were anticipating that when we do get a pivot from the Federal Reserve or the RBA in terms of what interest rates will be doing, that would be a bit of a tailwind for the markets. We haven't necessarily got a pivot, but there is clearly a change in sentiment around what interest rates will do. So, as we know, at the lows of the market in June, locally, everyone was talking about interest rates of 4%. The 3-year rates were sitting at a bit over 4, and now they've come back to a little bit over 3, and a lot of bearishness out there. And I think that's given way to a little bit more realism and optimism, and now we're getting a bit of a recovery. Of course, the big question is how far can it go? But we started to see signs of this a month ago in terms of the S&P 500 chart. So I'll just explain what we spoke about last time and what I'm seeing now. Because ultimately I do think that we can have a little bit more upside from here. So just looking at, so what we have here for everybody is a daily chart of the S&P 500. So when we spoke a few weeks ago, we had a bit of a bounce, and
it was around June 16 or 17 or so, wasn't it?
Yeah, or it might have been late June, but basically what I needed to see first was the higher lows. So the definition of the downtrend is where you have the lower lows and the lower highs. So you need to at least, in the first instance, see a higher low. So we got that higher low, and then the next main level of resistance was here near 3,900.
So it's gone through that.
It's gone through that. So when it comes to looking at the index and trying to determine if a low is in place, it's not one of those things, unfortunately, in most instances where you could say, okay, from today on, a low's in place, so we can move from 100% cash
science
to So it's what it does is it starts to give you clues, and it starts to do a number of positive things that stack up on top of each other. So in the first instance, a higher low, that's great. Maybe we can start buying something. Major level of resistance at 3,900, it broke that, bit more positive. This line here is the 50-day moving average. As we could see, for most of the year, it's been a bit of a problem because the market, I mean, here briefly, it got above the 50-day moving average, but it's generally stayed below it. It then got above the 50-day moving average. So that's another tick for things are looking a bit better. At the moment, it's hovering around just under 4,200, but the way it's doing that, to me, looks fairly positive. So these few factors are telling me that things are looking better. You can continue to add positions if you were looking to add positions to your portfolio. Where it might start to slow down is up here, just above 4,300. So here's where we have the meeting of a downtrend line as well as the 200-day moving average. So the 200-day moving average is also fairly important. So I think the S&P 500's got a bit of upside to this point before we'll need to reassess. But ultimately, it's looking good for the moment.
It seems to me that the prevailing fundamental view is, and you alluded to it, is that the interest rate scenario was excessively over the top. They've pulled back to being more realistic. That job number on Friday probably raised a question mark about the current optimism, and I guess the inflation number on Wednesday in US time and Thursday, we'll see it here. That's going to be important to what we're seeing. The market wants to go up, but that could be a curveball.
Yeah, exactly. And on the positive side of the ledger, we are seeing commodity prices fall back. So when you're talking soft commodity prices for corn and soy and so on, they're back to levels before the Ukraine invasion.
Oil
prices are going down. So I think the market's seeing that happening as well and thinking, okay, well, maybe we were a little bit too negative.
And I think I said that at the time, but still.
But there's going to be a lot of uncertainty, of course. So I think ultimately, even if the market moves up here, I think at best it needs to move sideways for a while so we can digest what's really happening, wait to see a bit more confirmation that central banks are going to stop with those rate rises, and then the market can then do its next leg higher.
I noticed on the weekend, Barry Bannister from a US investment company called Stifel, he actually lifted his end of year target to 4,400. Around that area you're talking, he was at 4,200 before, so he's becoming a little bit more positive as well. Let's go to our next one now, individual companies, REA. Now, when we started talking on this show about buying tech stocks, a lot of people would say, yeah, it's time to buy tech stocks, but really quality ones. And I noticed that REA has done well since we've been talking about it, has had a nice bounce. Is it a convincing bounce?
It is. So the good thing about this tech stock is it's important to have a look at these numbers here and just see how far it's really fallen. So obviously some tech stocks have fallen a lot. This is still a lot compared to other stocks in other sectors. But the good thing is it hasn't dropped as much as some of the other tech stocks. So that's a positive.
12 down to about 40 or 50 at one stage.
Yeah, exactly. So when they fall that much, it's harder, obviously, to recover. But REA, it's clearly taken the hit. It's pretty much peaked as soon as the 3-year rate started moving up at the end of last year. REA
interest rate, fear talk, hurt housing price scenario.
So look, that's a positive. And again, if we're looking at lower highs, lower lows, this line represents the previous higher low. Lower high. You think I'd get it by now?
You would.
I know it in my head. It's just not coming out of the mouth.
Okay.
So we've got this this previous lower high. First thing it needs to do, apart from putting in a higher low, as I mentioned with the S&P 500, is then take out the previous lower high, and it's done that. So that, in terms of that horizontal line, it's done it. Very nice bounce off the lows, and it's edging higher. It's sort of consolidating here, which is good. It's not seeing a rush of profit takers or whatever. So to me, this is constructive, and it looks like it's recovering. Again, interest rate sensitive stock, not just being a tech stock, but property related. Again, mid-June, everyone was pricing in silly interest rates. What they're pricing in now isn't so silly. So it's starting to make sense that we should get a bit of a recovery here in REA.
And we actually interviewed someone who looks at the REA business, and it doesn't do all that badly when house prices fall, because a lot of people put their house on the market and they're on there for a longer time. They earn a lot more money. So, but that'll be on Thursday's show where we're looking at that. But I might actually give you a rerun on this particular one before we do that. Let's go to a company like Tyro, a classic example. Quality company that has been smashed. Well, we thought it was a quality tech company, has been smashed. What's going on there?
So like a lot of these, we're getting a bit of an uplift here, and even though sometimes the day-by-day numbers look great, 5%, 10%, 20%, whatever they're doing in one day, as we could see, it's still just a small move compared to the overall. Look, very short term, it's getting high. There's a little bit of volume coming in. My concern with this one is firstly the drop, so it's already suffered quite a bit. But what I've got down here is the volume traded, and as we could see, each time there's been a sell-off, huge spike in volume. So basically that's showing that there's serious selling, unfortunately, whenever it has one of these announcements that the market doesn't like. So although it's recovering at the moment because of these big volume sell-offs, it makes me a bit wary that it's only one announcement away from another big sell-off that could bring it back down.
That's right. And the next big announcement will be the announcement of the new CEO. The existing CEO, Robbie Cook's leaving, going to Star, I think. But if it's a really good announcement, a really good person, it will go in the right direction. If it's not one that convinces the market that Tyro's heading in the right direction, I think you might be right.
Well, just on that note, it'd be interesting to see if the opposite happens. That is, one of the big buy signals that I sometimes see on the market is if they come out with an announcement and you've got your head in your hands, Peter, thinking, oh geez, here we go again. but it does the opposite and it's up on volume, and it doesn't make sense because the announcement's terrible. That tells you that all these previous sellers are getting back in, and that would be a huge buy. We don't know if that's going to happen, but a huge rally on what seems to be terrible news tells you that there's a bottom in place.
Yeah, interesting to see. But at this stage, if you're going to go into Tyro, it's a risk play.
Yep.
Let's go to Zip. Now, Zip was what, I guess, in a similar situation. Has it improved? Is it looking better than Tyro in terms of its recovery from its shocking lows?
Again, I think short term we've got potentially a bit more upside. Really hard to know how long this can kick on for. So again, the day-by-day numbers look pretty good. In this tiny little section here, it doubled in price.
Yeah.
And we could see that there was quite a bit of volume on the way up.
Yeah.
But this peak in volume coincided with this big sell-off day. So I think we've probably got some short covering.
Explain for people who don't understand that language, short covering.
So if you're short the stock, what that means is
A short seller has been trying to profit from a falling price.
Yeah. So instead of buying the stock down here and selling it up here, they're doing it backwards where they've sold it up here somewhere.
Yeah.
But at some point, they don't make any money until they buy it back and square their position.
Yeah.
So it's got to a point where obviously they're quite happy down here, but as it starts to get some legs, because maybe some people are buying
and
then
could be wrong.
they think, well, hang on, this is moving up pretty quickly and I'm not going to have much profit left if I don't buy it back. Yeah. And it just compounds and it just snowballs from there.
So it's like a short squeeze, isn't it?
Yeah, exactly.
Yeah, okay.
But I think it's got to a point where that was as high as it was going to go. So at the moment it's holding in there. It looks like it might try to get going again when I look at this daily chart. But that big sell-off on the highest volume is a bit of a sign that's not over yet. Again, at best, it needs to move sideways.
So you're still in the risk play. If you want to buy Zip, it's still a risky play. It's not like REA looked like a reasonably good reason to back that company. These ones still risky. MP1 has done, that's Megaport, has been doing very well lately. To me, just looks a little bit more like a REA than a Zip or a Tyro, but you're the expert, fire away.
Yeah, look, obviously up until the lows, again, just a big drop, sort of 22 down to 6. So this will take a while, a very long time to recover. What I've noticed here is, again, if we're looking at the lower highs and the lower lows, it started to get a move on in July, and this gap up here was quite significant because it went back above this previous high. So it's now put in what I think is a higher high. Unfortunately, it's just not kicking on. So I'm a bit neutral on this at the moment in terms of the way it's trading. I just don't like the fact that in these last several days we had this sell-off here back down to that line, which is just under $8, and it's still loitering down there. So if you've got a trading range here, Peter, if this was bullish, then any sell-offs should keep it in the top part of that range. At the moment, it's hanging around the bottom part of the range, which is a little bit of a worry. If it closes under this red line, this blue line, I'd be out of there quick, smart. So just keep an eye on this one.
Okay, right. Another troubled company. Whenever they have an announcement, it's generally a bad announcement. EML.
Yeah, it's just a bad chart. So we'll just have to go straight there. Obviously, it's dropped quite a lot. There's a lot of gaps down in the share price. At least with the other stocks, they're starting to get a bit of a move on, but this one's still making its lower highs, lower lows. So unfortunately, not ready yet. Yeah,
you would have to be dirty on having money in having a crack at EML at this stage.
Yeah.
Though I've got to say, this is a company that is being terrorised by the Bank of Ireland, and I've been told that they're going to try and look for a different central bank, but still, this is a big risk play. Now, Ordinate is, by the way, reservoir like Megaport and Ordinate, they do have quite internationally competitive technology, and I think they have been caught up in the whole technology sell-off thing. Ordinate. Gee, well, its chart's looking a lot better than anything we've seen so far.
Yeah, so yeah, this looks really good, and I've thrown a few indicators here just to help people manage that position. So the first thing I noticed is it bottomed in May. The market bottomed in June.
Yeah.
In other words, this was outperforming the market when
So
the market,
people were buying it even despite, even before interest rate stories got
big.
better. Yeah.
That's a big, and I've mentioned it on the show as well. If you could see a stock that's bottomed and heading higher well before the rest of the market, as tempting as it is to go and buy say an EML, you're better off buying something like this because it's already outperforming the market, and it's had a cracking run. So it is in an uptrend at the moment, which is great. What I've put here is this line here is the 50-day moving average, which, as I mentioned with the S&P 500, it's a nice indicator to give you a feel for if something's getting back into an uptrend. So, as we could see with Ordinate, since the end of last year, it was downtrending and it was staying under that 50-day moving average up until this point here towards the end of May when it started to rally and it got above the 50 days. So in some ways you could treat that as a buy signal. What I then like to do, if I'm not in AD8, but if I was in this, what I do is once it starts to get going and we've got a bit of profit on the table and it's getting into an uptrend, the question for everyone is, well, when do I take the profit? How do I know that's over? Well, firstly, we've got the peaks there in mid last year, so of course it's going to slow down up here at some point. Yeah. But what's good to do is you switch from moving a 50-day, instead of using a 50-day moving average as your trigger point, because that's, as we could see, it's a bit slow moving, and by the time it falls under that, you're not going to end up with much profit at all. Now that it's really kicking on into a trend, try to look for a tighter moving average. So in this case, I pulled up a 10-day, and we can see that over the last month, it's starting to follow that pretty well. Yeah. So if it was me, I'd now move to the 10-day moving average as my trailing stop. We could see it consolidating here. As long as it consolidates without pulling back too much, it could be getting ready for another move higher. But at some point, you want to take your profit if it's going to fail. And I'd use this 10-day. We could see at the moment it's trading at 970. The 10-day moving average is at 945. Just keep an eye on that. If it looks like it's going to close under that 10-day, I'd use that as the profit take.
And this point is only I'll get Andre, my fantastic colleague, to look up what's the all-time high for AD8 as well. You can do that, and we'll come back to it. Let's go to the next one. Just before we finish off, we'll let people know, because we're talking about, that was like a $10 high or something, wasn't it? Let's go and see what the all-time high was. BHP.
Yep, BHP. So I think this is recovering from here. We can see in the last year it's been pretty choppy, but as I always say with the commodity stocks, cyclical, you need to trade them. I think BHP's bottomed out. It's really moving along quite nicely. I think it'll get a bit of resistance here near $40, but it seems to be absorbing that at the moment. So BHP is one that we've picked up recently in this region, and I think that will continue to.
Yeah, I suspected you'd come with a chart like that, which basically said not a bad buying opportunity. And you come across with a company, I don't know, SLR. Tell me about it.
So this is a gold stock. So
what's its real name, or is it SLR?
Silver Lake.
I know
Resources.
Silver Lake. Yeah, of course it is.
Yeah, so
I just haven't bought it, so that's why I don't know the ticker code.
Yeah. So look, we still like resources in general. When I was last on the show, we tipped Mineral Resources. Yeah. I'm still happy to hold that. Yeah. Silver Lake is gold.
Had a good week last week, I believe.
Yeah, the first thing I'll mention is I don't think gold stocks are a good hedge against anything. No. That's a bit of a furphy, as you could see. It's since the start of the year, it's fallen.
It's a punt play with no income.
Yeah, exactly. Yeah. But usually the movement in the gold price in these gold stocks is obviously related to gold, but gold moves with the US dollar. Yeah. It's got this inverse relationship. I know sometimes.
So you're saying, for our audience who don't understand, if you believe over the next year or two the US dollar will come down, as I do, and Michael Knox from Morgan's does as well, that should be good for gold.
Yes.
Yeah.
That's right. So the
If history
US,
is any guide.
yeah, the US dollar's had a massive run, and it looks like easing off from here. And if that does continue, as we suspect, gold, other commodities will do well. So that's again my continued focus on that. So SLR, I think there's a bit of a trade here for anyone looking to capture a bit of upside in gold over the next few months. So just in terms of this chart, what I've noticed here is this is an RSI, which is quite simply a momentum indicator. We could see that the momentum bottomed in May and has been heading higher, even though the share price here headed lower. So that's known as divergence, which is a positive, and we could see that's the share price has popped higher. So now it's getting into an uptrend, and most recently it's popped higher, consolidated a little bit, and then started to rally again last Friday. So for what it's worth, I think there's an opportunity here just to capture a bit of upside in some of these gold stocks.
Great stuff. Thanks very much. Now, my colleague has just shown me that the all-time high for Ordinate is $10.46. So we're not far off that in many ways. We're in the $9.60 mark. Really glad that we talked about it a couple of months ago and pinpointed it as a possible company on the rebound, and it's actually happened. Mike, always great to see you. Thanks for joining us. I'm sure our viewers learn a lot every time you share your great insights. Mike Gable from Fairmont Equities. Well, joining me now is Paul Rickard, and he wants to talk about what some people might call a boring company in Horizon Holdings, but it really is an interesting company, Paul.
Yeah, Peter, look, boring is, I guess, any business involved in rail and haulage and logistics.
Coal.
And coal can be described as boring. But for many investors, they've gone into Horizon for the income because it's been a high yielder.
A good dividend payer, isn't it?
Good dividend payer, but look, grabbing the attention, it released its full-year results today. And all the attention in the market, in fact, if the AFR wrote this up as a big dividend cut. Now, it did cut its dividend, but that was by and large as expected. So the market, in fact, in some ways, the result today was actually a very small beat, both in terms of its earnings and also the dividend. It was actually a little better than the analyst forecast, but it was still a dividend cut. Yeah. And the market initially interpreted that as negative. Horizon sold down about 25%, dropped to about 6%. Recovered most of that back, about half of that back during the day. But look, I'd argue that's creating some value for others, simply because the market probably misunderstood what was coming.
Yeah, and so if someone bought Horizon today, approximately what dividend would it be on?
Yeah, they'd be looking at somewhere around about 5.6% for next year. Yeah. So Horizon is it's the old Queensland Rail, right? Yeah. Which was
a much more interesting name, Horizon, than Queensland Rail.
Which was privatised in about 2012, 2013. Don't quote me. Maybe it was even earlier than that. I can't recall. But so it's really got two parts of its business. The biggest part of the business, Peter, is very, very regulated. What it calls its below rail business, and that is it owns all the track in central Queensland.
Like Transurban owns a tollway.
Owns the roads. That's right. Yeah. So Horizon owns all the track infrastructure and maintains all the track infrastructure in central Queensland, and that exports all our metallurgical and also some thermal coal. So about 90% of Australia's metallurgical coal exports go over, carried across Horizon.
I guess
track.
even gas would go there too, Paul.
I don't know, Peter, but this is what mainly for the mines, right? Now, it doesn't own the carriages and the haulage, right? No. They're all independently owned, they're different operators, but this is the actual physical track. And that business is totally regulated, and that is about 55% of its earnings. It then also has a haulage business, that is the actual locomotives and in some cases the port infrastructure, and operates that partly in Queensland. It has a business in the Hunter Valley, which it's now trying to sell, called East Coast Rail, which is the Hunter Valley sort of transport, or locomotives that transport the thermal coal. Has a business in WA, bulk commodities, and has some other businesses across New South Wales and Queensland. And so about 45% of its income comes out of the so-called the haulage operation, this above rail business. And if that business is trying to grow, and what it's trying to do there, Peter, is actually get away from the dependence on haulage of thermal coal and move to so-called bulk commodities. And they're doing that for two reasons. One is that I guess everyone thinks at some stage that thermal coal will cease to be an export because...
might be 10 or 15 years, but it'll happen.
And I guess that was probably 12 months ago, pre-Ukraine. Probably people thought about that a bit differently than maybe they do today. And then secondly, that obviously that means it's sort of in the ESG sort of concerns of stocks, and so there are some investors who won't buy Horizon because
so a lot of fund managers won't buy them, particularly if they're in the ethical space. Yep.
So it's decided it's over time is trying to reduce thermal coal dependence. And it's recently announced the acquisition of One Rail, which is a big bulk commodities sort of business in Central Australia, which is a lot of other different types of things like grains and mineral sands and rare earths and copper and all other sort of commodities in Central Australia. And at the same time, it's actually divesting part of its of what's called East Coast Rail, which is its Hunter Valley.
Thermal coal
haulage business.
Yeah.
So, look, this is all happening. It's a very low growth business, highly regulated, pretty unexciting, but a good dividend payer because until recently it's been paying out about 100% of its dividends back to its shareholders. So yields above 6% have been the norm. This is lower, but it's still yielding about 5.6%. So market reaction today was it sold off from about $4.04 to about $3.80 about an hour after it was resolved, but it's bounced back. I think there's value in this stock, Peter. It's one of those companies.
Particularly if you're a dividend chaser.
If you're a dividend chaser. Now, the reason I think there's value is a couple of reasons. One, it's not without risk. So let me just explain the risk. Obviously, that you're involved in haulage of coal, which has got its ESG risks. You're also involved in the haulage of commodities, and also the track business gets paid on the number of trains going across your track. And so if commodity prices fall, you'd expect that there would be a reduced volumes. And then the third type of risk you have is as has probably been a risk more the last 12 months, maybe this is climate change, who knows, but more weather events, right? Yeah. So they've had lots of floods and sometimes trains don't run. Yeah. And you don't get paid if you own the infrastructure, and you don't get paid if you're a haulage company. So there are risks, but it's an attractive yield. Not a stock to chase, but market sell-offs create opportunities. Markets have probably misjudged what they're being told to create opportunities. I think at $3.80 to $3.90, it's reasonable for a dividend payer. I wouldn't go too much above $4, and I'm not expecting a huge gain, but I think you can quantify the risks. I don't know if we can put a chart up there, but you can see it's been in a fairly tight range. And I think I would almost describe it a bit like an infrastructure play, Peter. And it's one of those companies that argues that it will benefit from inflation and higher interest rates. At least it won't get penalised because a lot of its contracts are tied to CPI. So it actually wins out of things like inflation. And it sort of has pressures from wages and the things that go with it. But look, I think it's reasonably attractive. So not a stock to chase, but a stock you add to your watch list, market sell-offs, have a look at. Good for income players, and a bit of exposure away from some of the other income stocks there.
And given the dividend you're talking about, even in a bad time, it would probably still produce a 3 to 4% dividend. And when people are trying to put together a collection of companies that pay a reasonable dividend, it should be on their radar screen.
Yeah, look, I mean, it's right, and it is, it is reasonably low cost in the sense that it costs of labour and stuff, but they're predictable. Yeah. And so, a lot of it is regulated and includes how much a return it gets out of, what it's allowed to make out of its below rail type business. So, I mean, I think there's value there. I would describe it as lower risk as an infrastructure stock goes. But, again, you're not going to get rich out of it, but worth looking at if you're looking for, a reasonable, high frank dividend income.
Okay, and that's Paul Rickard on Horizon. And that's the kind of stuff you get when you're a subscriber to the Switzer Report. And that's the show for this week. Thanks for joining us. Don't forget, we have the Switzer Report. It's for subscribers. It costs you a little bit of money, but it does give you a lot of insights on where you should be investing. And two of the classic companies that have done really well have been Audinate and Megaport, which we've talked about a number of times in the report and also on the show as well. We do actually try to give you insights that the market generally misses because the market is very short term and we invest long term. Thanks for joining us. See you on Thursday.